Welcome back, everyone. Michael here with Offshore Citizen. Today, we're going to talk a little bit about tax strategies surrounding roll-ups, company sales, and all sorts of interesting stuff in that regard. So basically helping you if you're in a situation where you might sell your company in the future, or you're interested in buying some companies and taking advantage of structuring that in the most optimal way. There are some nuances here related specifically to asset purchases versus share purchases and how you should plan this from a tax standpoint that is pretty important. And so let's dive in and talk a little bit about those nuances today so you can help navigate. If you're here for the first time, welcome. I'm Michael, and we are some of the foremost international tax specialists in the world. So if you're interested in optimizing your global tax for yourself personally or your business, if you're interested in relocating and doing that as part of the process, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net. Okay, so really quickly, when you're doing purchases and sales of businesses, one of the most basic structural questions that can be asked is, are you doing an asset purchase? They sometimes refer to an APA, asset purchase agreement, or a share sale or share purchase. Okay, now just quickly, why? So the preference for investors, usually from the standpoint of the people selling the business, that is to say, is usually to sell the shares. Usually better from their standpoint. So the question then is, well, why would that not happen? And the answer is that when somebody is buying shares of a business, they are inheriting everything that goes along with that business, specifically liabilities that may not know about. So one of the most profound examples of this is Monsanto, very famous agricultural modified crops, chemical, pesticide, etc. company, was purchased, I believe it was by Bayer, a big German conglomerate, for I think it was like $120 billion. Okay. Now, about a year or two later, they lost a court case in which it was found that Monsanto had covered up knowledge that their product were causing particular types of cancer. And that was like to the tune of $1 or $2 billion. And then they have tens of thousands of other lawsuits against them along the similar line. So that's really bad for the company that just spent $120 billion to acquire this company, right? Not good at all. Obviously, that's not going to be the case for most companies, but there can be much smaller things. There can be employee disputes they don't know about, customer disputes they don't know about, supplier disputes they don't know about. They might have who knows what in terms of debts that they might own, etc. And so when somebody purchases the shares, the liabilities tend to go with the new shareholder, and that becomes problematic. Okay, so very, very important to recognize this and to say, well, if I'm buying, I probably want to insulate myself from risk. So as a purchaser, my default usually is going to be that I want to purchase the assets. And what I do is I have this asset purchase agreement. This lays out all the different assets that I'm wanting to assume. And then they're typically going to be transferred from whatever the legal entity is into my new legal entity. Okay, or it might be an existing legal entity, but it's a new owner of those assets, as opposed to buying the shares and taking over accordingly. Now, functionally, this is more or less the same because you will typically transfer the employees, the contracts, the websites, the phone numbers, the brand names, all that kind of stuff. But it's important to recognize that there's a really significant difference here. Okay, so here's the problem. Problem is that oftentimes, let's say you're doing some sort of a nice international structure and you're thinking to yourself, hey, great, I might like to get involved in investing in businesses in this country or that country, right? Well, if you're in a situation where you have to, for some reason, end up buying a company or assets, like having some presence in a country, you may expose yourself to that tax regime, even though you may have nothing to do with that tax regime, or you may not want anything to do with that tax regime, okay? So what this means is, let's just say I go and I buy a US company, okay? The US company is making money, that's great. The profits are going to be taxable in the US. Any dividends paid out are going to be subject to dividend withholding taxes. And maybe I'm thinking to myself, hey, no problems. At the end of all this, I'm going to sell the company and I'm going to be able to sell the shares and I'll get a tax-free capital gain because I don't live inside the US. I live in some place not taxable for capital gain purposes, right? Seems reasonable. However, then the buyers come along and the most frequent type of transaction when you're talking about small business sales is asset purchase agreements. Now, it is true that as a business grows, the bigger it gets, the more likely it is to do a share sale versus an asset sale. And so if you were to watch like a public company, typically public companies are just going to be a share sale. And it probably helps that, they're audited and there's reporting and compliance and disclosures and all this sort of thing. So the buyers can feel much more confident about what it is that they're getting than in a small private company. But most people watching this probably selling a company for, a few $100,000 to a few million to a few tens of millions of dollars, right? At the, tens of millions of dollars, maybe it's going to be a bit more common to do a share sale. Depends on the circumstances. But anyway, that's the deal. And so the problem here is, imagine if I end up having to do an asset sale. What happens? So the company sells its assets. That's a gain for the company. The company is taxed at a corporate tax rates on that. And then it has to pay out a dividend to me. And that dividend is subject to dividend withholding taxes, which depending on the country is anywhere from 5 to 30%. The default is 30. If you have a tax treaty, then it might be lower. And the best tax treaties are 5, but the US doesn't have a very good network of tax treaties. So there could be a pretty high chance that that's a fairly high number. For example, there's no tax treaty with UAE. If you're living in UAE, you get taxed. Not a good situation, right? So the question then is, well, what do you do about this? What are some other ways of planning it? Now, one way to do it is that when you're doing the acquisition, the foreign company acquires the assets. They don't acquire the shares. And as a result, they're held by a foreign holder. And in some cases, it might be as simple as that. Maybe you can just transfer the operation so that it's not locally US taxable. That would be great. This would be, pretty common if you're talking about, say, an online business or something like that. However, maybe you're doing a business that actually has operations in the US. And so you're going to end up being exposed to some kind of tax. Well, what are the things that are going to happen then? Well, you might have to then take those assets and put them into a US company. Or maybe what you do is you say, okay, well, I can retain ownership of certain parts of the assets or all the assets outside of the country, but I can set up new operations to basically monetize and run those assets within the country. Okay, that might be a possibility. Another thing is you might be able to have the assets and then rent them to a local entity that is basically going to monetize them on your behalf and generate returns that way. In each of those cases, the advantage that you end up with is you're in a situation that now when you sell the assets in the future, provided they're not US real property and things like this, which will typically trigger US taxes, provided that's not the situation. So for a broad range of assets, this would be true. Then you can have a sale of those assets, and that is not going to trigger tax on, in this example, the US side. The same sort of rules apply all over the world. So I'm generalizing here to the US, but it could be all over. Another way to do this might be that you say, okay, well, we're going to acquire that company, but we're going to apply debt to it. So the foreign company will provide debt. It does a loan. Now this loan, if it's a cross-border non-arm's length transaction, it's going to be subject to transfer pricing rules. You got to deal with all that sort of stuff. But let's assume that, that's taken care of. Then you're going to be in a situation where you can have interest payments that are paid back, which are a deduction to the local company and income to the foreign company. And that can help to reduce the local taxable income. First of all, as I said, that's transfer pricing. Number two, you are in a situation where there's often interest rate withholding taxes. Again, depends on the tax treaties and depends on the countries that you're dealing with. The US specifically has something called the portfolio interest exemption, which is often quite nice. So I will do hard money lending deals into the US specifically because of the fact that I can take advantage of this portfolio interest exemption. Sometimes you can do this, but there are restrictions in terms of if it's a non-arm's length transaction, so you have to watch that. There are also in various places, including the US, interest rate deduction limitations. So that's another factor that you have to be aware of. Essentially, you can only deduct so much of your income as interest. And so, yeah, you have to watch that one pretty closely. Although there are often some exemptions in terms of how high that can go. So for example, in the US, there's an exemption for under 25 million in revenue. So, you get into these various different scenarios depending on what it is that you're trying to do. But the bottom line is that this is kind of a different structuring way that you can go that can help you to reduce the US tax payable. Now, in that particular case that I'm giving the example of, the asset when it's sold is still going to be taxable domestically, but at least you're in a situation where you have some reduction on the overall income based on the interest expense that was created. And then, if it's an unsecured loan, you can probably rationalize fairly high interest rate depending on what's going on. It is also worth noting that there are fairly strict rules in certain places, such as the US. There's a particular area of the US code and things specifically related to, is this debt or equity? Because the line is often kind of blurred. And so they have various different things they'll look at. And so, yeah, all these need to be considered in figuring out what is sort of the best solution for you. But I think it's a pretty cool thing to understand that there are some ways you can optimize, and sometimes that involves using multiple entities, etc., in order to get something that is pretty good. So let me know if you have any questions, put them in the comments below. If this is something of interest to you, or if other kind of global tax questions come up, please reach out to us. As I said, you can book a call, calendly.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net, and I will see you all on the next video.